Imagine borrowing money and not having to pay it back for a whole century. That's not a fantasy, it's exactly what Alphabet, Google's parent company, just pulled off. They've issued a bond that won't mature until the year 2126. Most loans or bonds last 10 or 30 years, but this one stretches across generations. Why would a company with billions in cash decide to take on debt for such an incredibly long time? To understand this, we need to look at what a century bond really is and why it's making headlines in the financial world. Let's dive into how this move sets Alphabet apart from other tech giants and what it means for the future. Really grasp why Alphabet's century bond is so unique, let's quickly break down the difference between stocks and bonds. When you buy a stock, you're owning a slice of the company, hoping its value will rise. Bonds, on the other hand, are more like a loan. You lend the company money, they pay you interest, and eventually return your original investment. Alphabet raised $32 billion in the bond market, but about 1 billion British pounds of that is set for a 100-year term. This isn't just about raising cash, it's about locking in long-term funding and managing risk. Understanding these basics helps explain why such a move is both rare and strategic. Might wonder if Google is already rich, why borrow at all? The answer comes down to two words: artificial intelligence. Building the infrastructure for AI is incredibly expensive even for a tech giant. By locking in cheap funding now, while interest rates are relatively low, Alphabet gains flexibility and security for the future. They're betting that the money they borrow today will help them stay ahead in the AI race for decades to come. This strategy isn't just about today's needs, it's about shaping the next century of technology and innovation. Though who actually buys a bond that won't mature for 100 years? The answer is mostly institutional investors. Think pension funds and insurance companies. These organizations need to pay out claims and benefits decades into the future, so they love investments that offer steady, predictable interest over the long haul. Some investors also buy these bonds to trade them as interest rates change, hoping to profit from market shift. While it might seem unusual, there's a real demand for these ultra-long-term investments, especially from those managing huge sums of money for future generations. Believe it or not, Alphabet isn't the first to issue a century bond. Back in 1993, Coca-Cola did it. Motorola followed in 1997, and even Austria issued a 100-year bond in 2017. If you look further back, the UK once issued perpetual bonds, loans with no end date at all. While rare, these moves usually happen when big players want to lock in funding for the long term, often during times of economic uncertainty or when interest rates are attractive. Alphabet's move is just the latest chapter in a fascinating financial tradition that stretches back centuries. If you hear about Google issuing a 100-year bond, it might sound like a wild, futuristic move. But believe it or not, this isn't the first time a company or even a country has tried it. Way back in 1993, Coca-Cola made headlines by issuing a bond that wouldn't mature for a full century. Motorola followed suit in 1997, and Austria joined the club in 2017. If you want to go even further back, the United Kingdom once issued something called perpetual bonds. These had no end date at all. Moves like these are rare, but they tend to happen when big players believe they're locking in a great deal on the cost of borrowing money for the long haul. There's a catch to these century-long bonds. The relationship between bond prices and interest rates is like a seesaw. When interest rates in the broader market rise, the value of older bonds drops. This effect is even more dramatic for bonds that last 100 years. Because they stretch so far into the future, they're extremely sensitive to changes in interest rates. Imagine if rates doubled overnight, the value of a century bond could be slashed in half. It's a high-stakes game, and investors need to be very aware of the risks before jumping in. The potential for big losses is real, especially if the economic environment shifts unexpectedly. Big question now is whether this massive bet will actually pay off in the long run. We've seen something similar before. During the dot-com boom, companies poured billions into building fiber optic networks. The world definitely changed, but many of those companies never saw the profits they hoped for. Today, Alphabet's 100-year bond is fueling an AI build-out, but will it lead to real lasting profit, or could it become a huge debt burden for future generations to handle? Only time, a lot of it will reveal if this gamble was worth it. For now, it's a fascinating example of how companies and countries think about the future and the risks they're willing to take.